Hello and welcome. You're watching Business Plus. I'm Shweta Kothari. Angel tax is back in news. The Finance Ministry in a notification exempted as many as 21 countries from the levy of angel tax for non-resident investment in unlisted Indian startups. The list includes countries like the US, UK, France, excluding countries like Singapore, Mauritius and Netherlands, from which India gets majority of FDI inflows. Now, private equity and venture capital investment into companies rooted through these jurisdictions that are not mentioned will have to undergo scrutiny under the angel tax provision. We are on the show trying to understand what the new notification means, what is angel tax, and the implication for startups and investors in general. Joining me at this point in time is Anil Joshi, Managing Partner at Unicorn India Ventures. Also with us is Siddharth Pai, co-founder capital firm 314 Capital. Also joining us very shortly is Saurrav Sood, practice leader at International Tax Transfer Pricing SW India. With me is my colleague Kartik Malhotra in the studio. Kartik, we're discussing angel tax once again, top big story there. The new notification, and in line with what we discussed this morning, excludes 21 destinations, 21 countries that many say have a robust taxation system, are countries that you can rely on for investing in India, but not mentioning some very important major countries like Mauritius, from where majority of the funding comes in.
Singapore, Netherlands, UAE, of course, these are big destinations and investors which put money into Indian startups. And I think, at the onset, it seems like a move that is not going to benefit too many. If these are countries where there are investors which are funding Indian startups, we are looking at a much longer, a prolonged funding winter. So it's important to contextualize this in the larger ambit of whether investments should be taxed at all or not, right? So it'll be interesting to get the tax lawyer's perspective on this. But to look at it, an investment is a trade between money coming into a firm in exchange of stake. There is cash flow, there is a balance sheet entry, but it is not something that impacts the P&L directly. So there is no profitability. If there is no profitability, then should a tax rate equivalent to corporate tax rate of about 25% apply even on angel tax? I think that is a larger discussion that we should contextualize today. And number two, why shoot ourselves in the feet and make it unviable for investors in these hotbeds of investments, putting money into a very thriving, flourishing Indian startup ecosystem?
Those are, of course, important points that we'll have to contextualize during the course of this conversation. The reasoning for angel tax that many believe is retrograde. Let me quickly get in Anil at this point in time. Anil, thanks very much for taking time out. Let me begin by asking you, angel tax, the provision for which were reintroduced in the budget 2023, the new notification, of course, will come to it in just a while. But in line with what Kartik was saying, it appears that you are essentially taxing what is coming in form of investment for a startup in India from one of these thriving destinations. In a country where we talk about, starting up and startups all the time, does angel tax make sense?
See, the primary reason of introducing angel tax, I think a few years back was basically to, plug the gaps on or areas where the tax evasion was happening. But now what has happened, extending it to the wider investor base and excluding these 21 countries, I think is certainly going to impact startup funding. It is not impacting investors directly, for sure, but it will certainly impact companies which are raising money. And to give example, if I'm raising $10 million from an investor based out of Singapore or any of the 21 country mentioned in notification, then potentially if I'm not complying with some of the conditions for angel tax exemption, then I may be subject to almost $2.5+ million toward tax. Now, I don't think any entrepreneur or founder wish to do that, the implication of this will be forcing companies to move out of India and get registered in a jurisdiction where they don't have to face this kind of situation. So certainly it's not a happy situation. I think government need to look at, positively in including countries which are excluded. In fact, I was just looking at the statistics, almost 50% of contribution are coming from only 3 countries, right? Leaving, this few countries, out of tax exemption gambit, I think is certainly going to impact industry to greater, extent.
But Mr. Joshi, help us understand here, there is also, the fine print also suggests that there is a threshold on startups which are registered with DPIIT as startups. I understand there would be many companies which were registered as startups earlier before DPIIT even existed and would have scaled up beyond being really qualified as startups in that sense, but they still continue to raise funds. And from the countries which are not in the exemption list, and even other domestic investors as well as international investors which are now part of the exempted list. Overall, the complexity just seems enormous now that you are raising different stages of capital, different stake sales at different points of time to different investors. Now, how do you keep calibrating, calculating your tax, and what good does it do to a startup to really look at options beyond the relationships they have already and scout for partners where they are able to safeguard this 25%?
So see, there are two situations. One which is a classified startup. As per definition, the company which is 10-year-old, less than 10-year-old, and the company which probably would have crossed, 10 plus year may not get classified as startup. Now the basic, genesis of, this tax is basically, overvaluing the, underlying assets and investing at higher valuation. Now by nature, it is very difficult to value IPs or proprietary technology, and hence, this mechanism of, fair market value, valuation by certified, valuer, and now, this, further notification. I think the companies which are beyond 10 years may not be that much impacted because these are a bit of matured company, and I think their projections and cash flow and past history will be able to justify the quantified or qualified, fair market value.
Okay.
As far as investments happening at fair market value, I think the objective is not to have a blanket angel tax on any company, right? As far as one is able to justify their valuation, I don't see there is an issue.
Okay.
The issue will emerge on companies which are too young, who have to rely on projections. They don't have any historic background. Where if they are not able to justify the criteria which enable them to come under exemption, I think we'll really face the problem.
Okay, let's bring in Siddharth Pai here. Hi Siddharth, thank you so much for joining us. Wonderful having you on the show. Just help us understand fair market value. How does one arrive at it? Does it now mean that by definition every startup will have to employ a merchant banker, will have to get books audited by the big four or alike, and eventually arrive at a real market cap, and then the negotiation in any case becomes difficult for them to increase their valuation and get funding on an increased valuation. So their negotiation power also goes down. So help me make sense of both these scenarios. How do you arrive at fair market value, and what does it do on negotiation?
Of course, that's actually a fantastic question. First off, I can actually categorically state, I don't think there's a single investor in the entire world, not just India alone, that's actually used DCF or a valuation methodology to actually value an early stage startup. Even noted valuation experts like Ashwat Thamuran of NYU has clearly stated that new age ventures with limited operating history, it is impossible to actually value any of these particular firms for that matter. These firms don't have any operating history. These firms are getting into a new space for which there are no comparables whatsoever. There's a heightened sense of uncertainty about hitting their metrics or hitting their projections even, and mostly businesses end up changing their business model, changing their line of business numerous times over itself. So the entire idea of a valuation report is actually a theoretical exercise. And
so that's what my question is. How do you arrive at a fair market value? And therefore, how do you arrive at what is above fair market value on which the angel tax gets applicable?
So it's a reverse, this is basically a reverse engineering problem. Now, what normally happens is the investors actually ascribe a valuation to a company using some sort of heuristic. They believe that based on the pedigree of the founders, based on the potential of the company, based on the lack of competition, basis of changes in regulation, etc. This is the value that the startup ends up having. More often than not, the valuation is a function of I want to buy so much stake in your company for this amount of money. Therefore, divide the amount of money I'm putting in by the stake.
It's a negotiation. It's a negotiation which eventually gets arrived at as valuation.
Very true. Very true. Now, what happens is once people actually get that, then everyone actually goes and reverse engineers the entire process. Everyone actually knows this. This is standard practice across. Now, because regulations state you need a valuation report, people are actually forced to do this. Now, the biggest problem with this isn't the valuation aspect, because valuation is always negotiated. The reports actually come after. It's when the tax department sits and actually looks at your actual performance. Is it to your projections that form the basis for the valuation report, and any divergence between them actually causes them to reject the valuation report. India is unique in taxing capital as income. No other country across the entire world seeks to actually tax share premium, which is an outcome of completely legitimate business decisions as income itself. All this happened because in 2009 there was a very prominent case of some alleged money actually being circulated, unaccounted money being circulated as an investment into a private limited company, which is why in 2012 we saw this law actually came about. What is supposed to be an anti-abuse measure has now become a tax harvesting measure, and this is what the entire startup ecosystem is actually trying to has been fighting against for a long period of time. Valuation reports no one actually invests on the basis of a valuation report. They negotiate the value, then they decide to invest in it thereafter. The valuation report is a hygiene point because regulation is actually required. Rest of the world, no one actually gets a valuation report. They just agree what the price is, they make the investment in that, and then everyone carries on as is. And India, by the way, is unique. We have, for the same investment by the same investors in the same company, there are 3 different valuation reports required under 3 different bodies of law, under FEMA, under income tax, as well as under the Companies Act. This amount of needless compliance is actually dramatically affecting the ease of doing business. And this is one of the reasons why Indian startups have decided to actually move overseas as opposed to starting off in India itself. It's these regulations that are actually driving away entrepreneurship.
Okay. So, Mr. Joshi, Siddharth has a valid point here, but it's difficult for any Indian startup in this case to create so many compliance reports, and then at the end of the day, who is that final authority on deciding that yes, this valuation has happened above the fair market value price? Who decides that? Should you take the startup's word for it? Should you take the last investor, the previous investor, the second last investor's valuation or judgment of valuation, or will the tax department have their own criteria to evaluate valuation on the basis of which angel tax will be calculated?
So as Siddharth has rightly said, these are negotiated value as far as early stage, investments are concerned. And then it becomes an after effect, reverse engineering to arrive at a valuation which is done by a certified valuer. Now, I think as far as income tax department is concerned, I think they would be more concerned about, how it has been certified by the certified valuer. The, issue would come up if the same, valuation reports are, compared and evaluated, after a few years, where the numbers will be mismatched because these companies are still building product, these companies are generating IP. Now, IP have a different value, and business might have a different value. For example, we have one company which has 5 IPs registered world over for different market. Now this entire company is getting valued, basis their IP, and the acquirer is willing to pay for those IPs, whereas the business may be less than $1 million, right? Now, how do you value all this, in absence of any methodology, especially as far as IT departments are concerned, who are valuing only the revenue basis, numbers. So it is going to be a challenge. And as rightly told by Siddharth, there are 3 different reports required. The FEMA need a different report, IT need a different report, MCA need a different report. So certainly it's a cause of concern and very confusing for entrepreneurs.
In absence of a Mr. Joshi, in absence of valuation guidelines, because the stakeholders are still hoping to get valuation guidelines, what sort of tax liability are startups looking at as far as angel tax is concerned? I'm sure they're planning around the taxation structure. It's the start of the financial year, but there is no guideline on valuation out from the government so far. And from what our understanding of it, the government, the IT department will of course have to calculate taxes. What sort of tax liability are startups looking at? Saurabh is with us. Saurabh, thanks very much for taking time out. I want to come to you with that question, the one that we were asking Anil at this point in time, and that is with regards to valuation guidelines. And so far, I think, Kartik, what we've discussed is that it's very, very tough to arrive at valuation because it's essentially a negotiation between the startup that is looking for that money and the investor that is hoping to fund.
It's pretty much exactly the same way as listed companies operate, right? What is the valuation of a listed company today? It is the trading price of the stock into the number of shares. So technically, it should be the same for unlisted companies which don't have publicly tradable shares but are selling shares or selling stake in return of capital to a private investor.
Right.
So why should there be any difference in arriving at valuation? So the last negotiated value of a company is technically the valuation.
Then how do you really arrive at
so
what
how
is
do you
a
arrive
fair
at fair market value and the markup over that?
Absolutely, but that will be taxable. I think we'll get in Saurabh to answer that. Saurabh?
Yeah, so I think what they have done is with the valuation guidelines proposed, which is yet to come, the fine print, the intention is basically to check on the excess money that is being flowed into the economy, which is beyond the otherwise reasonable valuation. So if you see that
the question therefore is, what is the reasonable valuation, Sood? Mr. Sood, how do you come up with a reasonable valuation if there is an absence of valuation guidelines?
When I say a reasonable valuation, the intention of the government that I'm able to decipher from all these changes in the law is that they don't want that all these DCF methods and the NAV methods are basically exaggerated to come at a price at which you are bringing the money. Now, what I just heard while one of the panelists was saying is that for the shares which are being traded on the stock exchange, you have something like a visibility, which is being traded at par with everybody at a larger share, whereas in an unlisted share company, which is mostly the startup ecosystem, there is no visibility on how you have derived at a particular value. Definitely there are sentiments involved, definitely there is a business model involved, there is a technology involved, but that visibility is not there to the person who is seeing that valuation has been done at 3x or 4x. So now with these valuation guidelines that we are hoping to see, I'm assuming that they will be capturing these type of sentiments into a more methodical approach, I'll say.
Okay, let's get Siddharth Pai. Siddharth, you were mentioning this, and in fact, even I opened, my first statement with the same concern, that why is it that you're looking at an entry which is a cash flow, yes, and by way of being an investment, it's a balance sheet entry. It's not a P&L entry. What is the merit of taxing an entry which may or may not have anything to do with profitability at the end of the day? How can you tax investment money coming into the cash flow and the balance sheet and not the P&L?
No, that's actually a fantastic question. Like I said, all this arose because there was a case in 2009 where the tax department believed there was a large amount of unaccounted money that was actually invested into a premium into an unlisted company. What happened a little time after, apparently, is that the investor of that particular company decided to sell back its stake to the promoters of that entity, thereby ensuring that the promoters held 100% of their enterprise and they actually got a large amount of money into that particular company without paying any taxes.
But because Siddharth, there is an exception, and if there has been a case, I think there are better ways of figuring out frauds 100%. In the system by asking 100%. For audited books, by making certain disclosures mandatory, and a scrutiny like is the case for Indian citizens. There is a random selection for scrutiny. There should be a random, maybe a little more detailed scrutiny of startups as well, as opposed to one axe pretty much slicing off 25% of the income coming into that startup by way of investment.
No, very true, and this is what the industry has actually been speaking to the government about. We said, look, we don't mind actually dematerializing all our securities. So in case any trade or anything happens, that there is traceability that's actually built in. We don't mind, and everyone now who owns securities in an unlisted company has to mandatorily actually disclose those investments in their income tax return also. So traceabilities come in. Now these transactions can happen for cash. Everything has to happen through a valid bank transfer. A PAN card is now mandatory for making any of these investments and the reporting that's there. Given the fact that over the last 10 years, 11 years, we've had so many changes in regulations. This is an artifact of an older generation before startups in India became particularly large. And right about now, it's mainly startups who are actually suffering. And in the light of the funding winter, the fact that the three largest sources of FDI into the country have not actually got the sort of safe harbor provisions that the government spoke about, there is a heightened sense of uncertainty that's actually prolonging this entire funding winter. At some point in time, Indian startups will run out of money. And when they actually do, no investor wants to cut a check with the fear that 25% of their capital is actually going to go to the tax man as angel tax itself. So I think this fear in a particularly stressful macroeconomic situation has caused a large amount of ambiguity and uncertainty, which is actually preventing investors who want to invest from actually taking that particular plunge as of now.
You're right.
So I think a more framework is actually required, and it is actually the need of the hour as well.
You're right. So let's get Mr. Sood back in. Mr. Sood, now if this tax is paid as angel tax, for a loss-making startup, and many of them are loss-making startups, for a loss-making startup, can there be some reconciliation at the end of the financial year? Will they get some refund on this tax, or this is gone, 25% off the books?
So how these provisions have been drafted is that whatever is the excess money that you are receiving beyond the valuation, all that money goes into taxes irrespective whether you are a loss-making startup or a profit-making startup, and you don't get a set-off in the subsequent year. So
it's the money that's not coming back,
essentially. This question, just a point to add is, they have made these provisions as a deeming income. So irrespective whether you are earning an income or not, the excess valuation is considered as a deeming income in the hands of the startup. So definitely these are draconian provisions. These are provisions basically to instill some sort of less confidence in the investor and for the promoter, where you are not able to negotiate at a price at which you actually think those startups should be valued at, and you will be more driven by the numbers, you will be more driven by the paperwork.
Correct. So Siddharth, come back here. Now, does this mean we are actually creating a pathway to a 2009 situation repeating? Because startups today will be very jittery of raising money beyond their fair market valuation, whatever formula used to arrive at that. They'll be very jittery disclosing through press releases, through other forms, and raising real clean money, morally clean money on the basis of anything in excess of the defined fair market value. So are we looking at avenues for startups to find loopholes to evade paying this 25% tax?
You're right. So what normally happens is everyone makes sure to actually end up investing at the same. Let's say, for example, if I'm investing at a share price of 15,000 rupees a share, I will make sure that the value what I get ends up giving me a fair market value report which says 15,000 rupees a share. If the entire matter ended there, this is just another compliance people had to do. Now the biggest problem is that the tax department actually 3 years later, not immediately, 3 years later will come and ask you what's your actual performance, what are your projections, why is there a divergence, hence his report is false. The number of valuation reports, valid valuation reports by reputed valuers in the country that have been summarily dismissed by the tax department is huge. There have been cases where 100 startups have come up and actually said a few years ago, I think in 2018, 2019, to say that we are actually aggrieved. We've had our money stuck up in our tax refunds, unable to raise capital from investors out of fear that the money will actually end up going to pay this particular tax. All our shareholders have given information about where they got the source of money from. But we're still facing this issue. That's why the government also announced, really saying that it won't be the assessing officer, it'll actually be the commissioner of income tax or someone above him who ends up actually doing that, taking that particular call. But this is just additional layers of bureaucracy for a matter that was never supposed to have been taxed in the first place itself. Like I said, it's a tax on income. Capital receipts are not income. Income receipts are income. So by converting capital receipts to income, we're actually doing a massive disservice to the entire industry and to investors who want to capitalize upon the India story, but are thoroughly frustrated with these random acts of bureaucracy that are preventing them from actually investing and actually growing their businesses.
Yeah, agreed with you, completely in agreement, Siddharth. Let's get back Mr. Anil Joshi. He's back with us. Sorry, Mr. Joshi, we lost you briefly. Good to have you back. Now, help me understand what seems to be any logical rationale of excluding countries like Singapore, like UAE, like Netherlands from, and Mauritius. Okay, Mauritius is still understandable. You know, it's been a tax heaven. It has been, you know, in the grey zone for a while. But countries like Singapore, UAE and the Netherlands are very important for the Indian startup ecosystem. But we are subsidizing or exempting countries like France and Spain and Germany that have hardly made any investments in the Indian startup ecosystem. So why would we kill, you know, the hen that is laying the golden eggs for the Indian startup industry and start feeding another hen that may or may not give us any eggs at all, golden, silver, black?
No, I know it's a very, you know, dicey situation. Looks like, you know, while many countries have been, you know, excluded, but the main 3-4 countries which are contributing around 50% seems to be all, you know, tax neutral, or there are no, you know, capital gain tax, right? I think probably government is trying to bring, you know, capital gain tax, you know, countries, you know, as a preferred list, where the tax either here or there, you know, can be levied. But it is certainly going to impact, you know, the funding scenario. My worry is more in lines with, you know, what Siddharth had said earlier, that it will force more and more good company to move out of India. I think in long run, we'll not only, you know, land up, you know, taking jobs out of India, but at the same time, the future tax revenue which government could have got it from this, you know, grown-up companies, I think will also move out of India. So it's not, I think it's a short-term myopic view compared to what government actually can look at long-term, and certainly need to look at, you know, revisit, you know, these excluded countries, especially what you have said, that, you know, some of the countries, you know, which may be, you know, a true partner will also lose out because they're excluded. So it's not a happy situation as far as startup scenario is concerned.
Sure. While I agree with you, sir, let me try and play devil's advocate here. And Siddharth, let me, you know, come back to you. Now, is this perhaps, and I'm just playing devil's advocate, I'm not sure if this is going to work, but could this be a case where we are looking at restricting direct investments into startups by VC funds, PE funds based in these non-exempt countries, and getting them instead to form special purpose vehicles for making investments in startups? Is that likely to soften the blow to begin with and create greater financial avenues through these SPVs within India?
Not necessarily, because see, what happens is this not so investing globally is not actually the matter of just creating an SPV in the country and actually investing. There are tax issues, permanent establishment issues, management issues that actually arise. To prevent the abuse of tax havens, most of the governments across the world actually insist on some level of substance, to have senior people deputed over there, make sure that business actually happens, and make sure there's analysis that happens from these particular areas itself. Now, even if you look at it, if you create an SPV, and the way the regulations have been drafted as of today, unfortunately, in order for you to get this exemption, you need to have a minimum of 50 investors. So that means you have to create like 50 different SPVs, put it into one fund, and end up actually doing it. Very few investors want to actually jump to this level of hoops to end up actually investing into any other country, let alone India itself. So I think the greater level of friction you actually engineer over here, the bigger the problem is. I think what the government has actually done with this exempted list of countries is to actually send a signal that these are the jurisdictions, the preferred jurisdictions for investment into India. Now, in case you're coming from a Singapore or Mauritius, anywhere, why don't you actually look at redomiciling or shifting your base or your investing base to India? But that's a medium to long-term view. That's been a long-term action that will actually end up taking time to actually take place. Given the fact that the country is actually heading to elections in the next year itself, obviously the risk factors and risk perception in India actually increases. Anywhere across the world when there's an election, the risk indicators end up actually increasing. So for that particular point in time, where the ecosystem is actually starved of funding, to exclude the largest sources of FDI coming into the country is extremely tough. It takes them anywhere between 6 months to a year to actually create a new jurisdiction, run the analysis, and move all of that. But the Indian startups ecosystem doesn't have another year to actually end up waiting for investors to restructure their operation before they can actually end up raising capital. I think a bigger point of question is that we're already in the end of May as of now. What happened to the companies who raise money from 1st of April 2023 all the way till now? Now, in case they actually raise money from an investor in Singapore or Mauritius,
bad news for them is all I can say. This is going to be retrospective, right? So it will happen.
It is retrospective. It clearly stated over that it's a retrospective. It's not going to aggrieve anyone. But there will be a small section of investors and companies who raise money who will be aggrieved by this.
Yeah. So, so one more thing. Now, you said that in the long run, it may work in India's favor. Could it be maybe us as a country trying to build a case to get funds within the Europe region, Russia, etc., to set up shop in India, or at the same time look at other American firms which are perhaps routing their Asia investments through Japan or through South Korea or through Singapore to actually set up base in India. Could it be, again, I'm playing devil's advocate, could it be a case to get more foreign funds to set up shop in India and route investments into Indian startups sitting in India rather than sitting in Singapore or elsewhere?
It could be, but I think, see, the merits, the national merits of the Gift City initiative, or Indian Airs for that matter, can actually stand alone on their own merits itself, as opposed to needing this sort of regulatory push. A number of investors have started looking very favorably at Gift IFSC, at the Gift City fund, and they do actually want to end up investing from India. They're already in the process of actually seeking their approvals, doing their due diligence, etc. But this sudden gun to the head makes them actually alarms them. See, the moment
technically it's not a gun to the head, yeah. Technically, it's not a gun to the head. You are actually just emptying the barrels of somebody else's revolver, but you're not putting the gun to anybody's head. No, but so you're just incentivizing or disincentivizing a certain few geographies in the world.
No, but you are. What was clearly allowed, what was clearly permissible, has suddenly now changed, and there's no rationale given why these 21 countries have been excluded versus not. Singapore is actually renowned across the world as a sort of treasury of Asia. Yeah. A number of American companies, European companies, Indian companies actually do have entities over there, and they have been going through it. The FATF, I don't believe, has found any issues with Singapore so far. With Cayman and Mauritius, they have found issues. They are actually trying to get out of that.
Correct.
But Singapore was the biggest question, biggest surprise to everyone, because there are a number of investors, especially global funds, end up actually creating Singapore as a regional headquarters, and may call it the allocations from Singapore itself. Or they used to do it from Mauritius in case of actually independent funds. Then there's a complete rewrite, and the rewrite is happening without giving industry any amount of time. If they announce that these are the countries that are going to happen, but we will only institute this from, let's say, 1st of January 2024, then it gives industry sufficient amount of time to actually restructure operations. Right about now, people are actually scrambling, talking to their tax advisors and the like, and trying to figure out what can they actually end up doing to ensure that their investments don't actually suffer this particular angel tax. I think the paucity of time is something that paucity of time has actually left a bad taste in a number of investors' mouths, especially at a point in time where they're already reluctant to actually end up cutting a check, not just in India but the rest of the world. This level of regulatory uncertainty and this sort of regulatory action has actually caused concerns. The way it's actually gone.
So,
correct me if I'm wrong, Kartik, but the taxation, although it will kick in from April of this year, you will obviously be paying up the taxes by end of this financial year, and which means by that time,
in this case, because that is the income that you pay, that is the tax that you pay on your income. In this case, I think and maybe Mr. Sood will be able to correct us.
Absolutely.
But the moment the investment comes in, knock off 25% straight to the government.
Mr. Sood, is that the case?
So what happens is, when you pay the tax per se, how the taxes is, you will have to pay the taxes at the end of the financial year. Of course, when you do the valuation, you will have to factor the 25% taxes on that.
But just Mr. Sood, this is not tax on income, this is tax on investment. Investment comes in.
Tax on the capital investment, definitely. But just to add,
but treated as tax on income.
So then why can't it be adjusted against losses?
No, so what happens is, this is a special tax. This is not a tax on the business income that they are taxing. This is the other sources taxes. So when you have other sources tax, that other sources as an income to be taxed, that is a separate category altogether. Just to add to,
so my understanding of it is categorized as income from other sources. Is that correct?
Absolutely. Yes, absolutely. So
but how is it fair to categorize it as income from other sources in the first place? This is no income. This is investment.
So this is considered as a deemed income. This is not an income that you have earned. This is not a passive income. This is a capital that is deemed as an income over the difference between the valuation and the difference between the price at which you have received the investment.
And so I think that brings us back to square one, the discussion around valuation. And interesting, Kartik, because we were having this discussion in the newsroom with one of my colleagues, because valuation, as Siddharth mentioned, is a very difficult ball game. I say I'm selling you this product for 200 rupees, and if you're investing in it, you say that I'm only going to give you 180 rupee.
And
What
I
is
say,
the
no,
fair-
I'll just pick
and
up
the
the
income tax
battery
department-
I'll just pick up the battery for $1,000 and that is
Absolutely.
10% of the value.
And the income tax department says, no, but the fair price of this is approximately 250 rupees. So what happens in that case?
Yeah, that's what I think. That is what the debate is all about. How do you arrive at a fair market value? How do you decipher whether an investment you have raised is above that fair market value? And what Siddharth was also saying, that you arrive at valuation after the deal is done. You don't arrive at the value and then go and close the deal. So and arriving at the valuation is the function of negotiation between the startup founder, the entrepreneur, and the investor. But
So, Siddharth, in which case, do you see startup founders underplaying their valuation or overplaying their
they will
valuation?
underplay it because they will not want to pay this additional tax.
But in which case, you don't even raise that money.
You don't raise that money, but then you find other avenues of still getting that money without technically
Paying
a
up,
transfer.
Paying up that money.
So you
Siddharth?
may get the investors to pay for your advertising. You may get the investors to pay instead for the brand ambassador you're using, for other other expenses that you are likely to incur. You may ask the investor to pay for those directly without that hitting your books, and that is going to be circumvention of
the angel
rules.
tax laws. Siddharth?
No, I think, see, what's essentially going to happen now, it's very hard for investors, institutional investors, to actually subsidize operations in this particular fashion. I think what investors are looking at is to make sure the stake they have in this company is actually going to be secure. And for that, an investment in the company is actually imperative. I think what we are going to see is a number of investors who are asking their companies to move to India are going to actively encourage entrepreneurs to actually move their base itself to Singapore and the like. I do happen to know of a few funds investing in India who actively ask their portfolio companies to shift their base overseas, even sponsoring some of the initial investment the entrepreneur has to make in order to qualify for an entrepreneur visa or the like itself. These sort of programs do actually exist. And what we will end up seeing is the brain drain that the shift of startups overseas, which actually started to reverse, may actually now end up actually coming back into favor itself because of these kind of regulation. But the hope of the industry remains that maybe Singapore, Mauritius, Cayman, etc., do actually come back into the mix with additional compliances that can actually end up happening. There is still a large amount of interest for Indian entrepreneurs to remain in India. But if they are going to be starved of capital and there are going to be regulations that end up taxing 25% of their entire capital raise, it makes the stance for them to end up remaining in India exceptionally hard. This is placing investors and entrepreneurs in very, very shaky grounds. No one knows what to do.
Agreed, Siddharth. I just want to get Mr. Joshi in. Mr. Joshi, so do you see that happening? Do you see more cases of Indian founders registering their companies outside of India so that they can continue to receive investment even from these non-exempt countries and yet not fall under the ambit of angel tax?
Yeah, that's what actually, we are expecting to happen.
So isn't that horribly bad for a country which is seen as, pretty much the emerging Silicon Valley of Asia, one of the largest number of startups registered with DPIIT, 85,000 or something? Why would the government want to create this case where they end up not setting up shop in India technically and doing it elsewhere?
And a huge dent on India's dream of stand-up India, start-up India.
I think stakeholders have been wrongly advised about this, issue. In terms of plugging some short-term, gains, I think government or India in general is going to lose much in long run, because ultimately you will land up, moving your company, the headquarters out of India, and maybe more lucrative for some of the investors if they move to countries like Singapore or countries where the tax exemptions are much better laid as compared to India. I think it's not a happy situation for sure. It is certainly going to make, because no company is going to endlessly wait for regulation to change. If they are dying out of money and the only way for them to survival is to move out of the country, I think the first thing they will take first flight to go out of India and set up their country, they set up their company outside India, right? Nobody is going to allow their company to die, right? So I think there is a SOS need for revisiting, some of the exempted and non-exempted countries and make it more stand-up India friendly rather than what it is, right? I don't think government is going to make much money out of this or much tax revenue out of it, but certainly going to lose much beyond everybody's imagination.
True,
so
difficulty of doing business rather than ease of doing business. Sunil, so let me get you in at this point now. If there were a fund which were to move base into India outside of, let's say, a country like Singapore and UAE, but the parent company may be, elsewhere, perhaps in one of the non-exempt geographies. Now, if the parent fund was to liquidate this Indian fund, add liquidity into this Indian fund to invest in Indian businesses, in this case, is the transfer from the parent company to the India fund seen as investment and hence liable for 25% angel tax? B, part of the same question, if that is yes or no, either way, the investment that this Indian fund, the child of a parent fund abroad, making investments in Indian startups, will that be under the angel tax ambit or not?
I think just to answer your question, what I'll say is that so this angel tax is basically a tax on the entry. It is not a tax on the exit. So when you say it's a tax on the entry, that means that when you are investing in a company, at that point in time, what is it that you are investing beyond the stipulated price band? That is what they're deeming it as an income. Now, if an angel fund is investing into India from its parent fund, which is outside India, if that fund is in any of these, so they have specifically exempted few categories of fund, which includes the government funds, the sovereign wealth fund. But if you're not following on those categories, you will definitely be coming under this provision of angel tax. But I'll just give you a perspective while I was listening to this. These 21 countries, why they have exempted, if I may be adding to it, is if you see how the funds are basically inflowing in the startup system is, Singapore, Mauritius, Netherlands, and all these are basically countries where your SPVs are set up. Practically, the funds are being invested from the developed nations only. What I think government is wanting to achieve out of this is that they want the investment to come directly into India instead of coming through an intermediate jurisdiction. So it may be a situation that they don't want the treaty benefit to be given, but it is also a situation that they want the funds come directly. And if you are coming from a mature jurisdiction, if you are coming from a jurisdiction which is directly investing into India companies, they are giving that exemptions over there. And they have specifically excluded them. Now, if you are investing through a fund vehicle, and fund vehicle is not a recognized fund vehicle that they have given as a category of recognition, definitely this will trigger the angel tax provision on these investments to be made.
All right, important story there. Angel tax refuses to die down. Conversation once again started in 2023 after the finance bill made provisions for angel tax to be reintroduced. There is an exemption list of 21 countries, but that's not enough. Many VC funds and startup founders are hoping that the list will be expanded, or as Rakesh mentioned in the morning, there'll be a second list, including perhaps these hot destinations. We don't know. We are of course hoping that anything that is retrograde and prevents startup community from exercising benefits of living in a thriving ecosystem will be done away with. We will of course keep tracking that story. Gentlemen, appreciate you joining with your inputs on that very important story. We're going to move on for now. Goa Fest